Well, billion-dollar buyouts are back in the headlines. And if a deal is getting done these days, odds are that Morgan Stanley was involved. That bank is advised on more than $500 billion in global deals so far this year. And in a rare interview, I spoke with the global head of mergers and acquisitions at Morgan Stanley, Robert Kindler. I began by asking him whether M&A is truly booming.
I'm a little bit skeptical that this number of deals is an indication of a lot more going on. But I do think as the years progressed, we basically spent the first part of the year with companies focused on their balance sheet. And you had a lot of very large companies, Alcoa, U.S. Steel, and others, doing things to raise equity capital and to help their balance sheet. So that was the focus through most of the year. And almost the last thing that CEOs were thinking about we're doing strategic deals. I think we're through a lot of that. I think a lot of the capital's been raised. Equity market's pretty good. And now finally CEOs are starting to think about it again. But I think it's a bit too early to call the bottom of the market for M&A.
Is it a starting place, I guess?
Well, if you look back over the last 20 years, M&A peak to trough has been about two years from peak to trough. It just seems to be, it's a cyclical business. And no one knows why it's a cyclical business, but it just is. So the peak was in 2007, so the trough probably is now. But you really don't know. One of the things I think that cuts against thinking that this is the beginning of a boom is that the equity markets have been so volatile. Right. The last several months, we've had a huge uptick in the equity markets. And usually volatility in the equity markets is not conducive to M&A, because people just want to see the market settle down to some normalized pricing level before they act.
Are you seeing that sort of inhibition when you talk to executives on the potential of doing mergers and acquisitions right now? Is there sort of a fear, or is it simply just cautiousness that's pervasive in most aspects of business right now?
I think there's caution. One of the things that's been interesting of the most recent deals is early on in the year, people were doing deals that were right in the sweet spot, you know, strategic deals. Wyeth doing a deal with Pfizer and Shearing doing a deal. And in those deals, it was very clearly defined companies doing very conservative deals. And so that's, again, a sign that people did not want to do something that was far afield. Interestingly, the last 2 weeks, we've seen the Xerox deal for ACS, and we've seen the Dell deal for Perot Systems. And those deals were viewed as transformative deals, totally changing the company. Well, the problem has been near term that the stock market has punished those stocks to some degree. I think people will see the strategic merits of them over time.
But there's a punishment for taking risk right now.
If you take risk, there's something of a punishment. So in a way, you can't win as a CEO, because you're going to get punished if you have a low growth business. Everyone's looking for growth. And if you try to do something that's transformative, you're going to get punished because you're going outside of what your core business is. I think over time, people are going to look at the Dell deal for Perot and the Xerox deal for ACS as very good transformative deals. When
do you think that transformative element is going to play out, and when do you think private equity may start to participate in this?
Well, I think private equity is going to be on the sidelines on certain deals for a while. And those type of deals are the large acquisitions, $5 billion plus acquisitions. And the primary reason that the private equity groups are going to be out of that is that strategics are back. If assets are on the market, a strategic's much more likely to be able to buy it with synergies. But the private equity firms have always proven to be very smart, very adaptive. They thrive on doing deals. So they already are back, but in different forms. So you saw, I think it was 3 weeks ago, Kodak did a very creative deal with KKR, where KKR came in, helped on a liquidity side and, you know, a debt instrument. And that was it also was a show of faith in Kodak. So the private equity firms are going to be there, but not in very large deals.
One of the main deals that's getting a lot of headline attention right now is the potential of a Kraft takeover of Cadbury. What options are on the table ahead of that November 9th deadline they face?
Well, we're advising Cadbury, and obviously I can't comment specifically on strategy, but I think what is interesting again about that deal is that it is a strategic coming back and looking for a business that gives it high growth. That just becomes, from the Kraft perspective, it basically shows that they had to do something from their perspective. As to what Cadbury's options are, I just can't comment on that.
When you're talking about the level of apprehension that you're sort of feeling in a certain way from the marketplace as to the degree of risk-taking, when you hearing that cautiousness when you're talking to executives, I mean, what's your advice right now? What
CEOs have to look at is, what are you actually paying for the underlying assets? Market values don't really mean very much. What really has meaning is, how much are you really paying? What multiple of cash flow are you paying? What's your return on equity going to be? In fact, too many CEOs are being forced to look at growth for the sake of growth. And growth for the sake of growth, I don't think has a lot of significance. What has significance is return on invested capital, is actually making money. And you use an example of the PepsiCo deal, and we advised PepsiCo bottling. I think it was a very smart deal for PepsiCo. They said, we want to take control of our distribution. That's a core part of our business. It's a business we know. And the market liked it a lot. So I think, bold moves like that, are those kind of bold moves within a business that they knew are going to be rewarded.
Kindler says it has still been a difficult year for M&A. It takes about 4 to 5 months to get a deal done, and volume's down.